Imagine this. You're sipping your morning coffee, scrolling through the news, and a figure catches your eye. It's so out of place you almost dismiss it as a glitch, but it's there, and it sits in your mind, humming with a quiet, unsettling energy. Because some numbers aren't just data, they're alarms. And the one blinking right now is telling us that a market we all thought was stable is tearing itself in two. This is what I'm looking at on Wednesday, January 14th, 2026. In Shanghai, the trading session just closed with silver priced at $104.55 per ounce. In New York, at the exact same moment, the world's benchmark price is $91.67. The distance between them is nearly $13. Think about that for a second. $13 for the same metal, the same ounce, the same element pulled from the earth. In any normal market, that gap would be obliterated in minutes by traders exploiting the difference. The fact that it exists and is in fact growing daily tells us one thing: the normal market is gone. What I believe we are witnessing is the end of a pretense. For decades, the price of silver was set in a paper realm of futures contracts and electronic trades. But a price is only real if it's connected to a thing. The $13 chasm is proof, in my view, that the connection has been severed. The paper market in the West is quoting one price, while the physical market in the East, where people actually take delivery of the metal, is trading at another, far higher one. The link between them, the physical shipment of silver to balance the scales, has broken, not because the ship stopped sailing, but because the vaults in the West are empty. The metal isn't there to ship. So the prices drift apart like continents after an earthquake, and the map of global finance is being redrawn in real time. Let's talk about yesterday because it makes today's move so much more significant. The powers that be tried to stop this. The CME exchange raised margin requirements, a classic move to drain oxygen from a rally. It was, in my speculation, a direct attempt to force the little guy to sell and to shield the massive short positions held by big banks. For a moment, it seemed to work. The price stuttered. Then, it didn't just recover, it roared higher. The paper tactic failed because it crashed into a brick wall of physical demand. The people buying in Shanghai and Mumbai aren't trading margin contracts, they're trading metal. And they are paying $104, $132, whatever it takes. When your factory needs silver to operate, or your family needs it to preserve wealth, a margin hike in Chicago means nothing. The failed manipulation shows who now holds the power. This is where my analysis leads me. The banks are cornered. They have bet against silver for years, selling what they did not have. Now the price isn't just moving against them, it's leaping to another planet entirely in key parts of the world. To close their bets, they would need to buy physical metal, but to buy it, they would have to compete at Shanghai's price of $104 or India's price of $132, instantly vaporizing their capital. It's a trap of their own making. Their only move is to try to keep the paper price down, widening the spread further and screaming to the world that their market is a mirage. Look beyond silver for a moment, and you see the same story written in other assets. Gold at $4,644. Bitcoin holding firm above 80,000. This isn't a silver story, it's a currency story. It's the visible tremor of a global loss of faith in paper promises. When bond yields spike and gold soars simultaneously, it's a signal that trust is leaking out of the system. People are moving value into things that can't be defaulted on or inflated away. And right now, in the chaos of that rush, silver is flashing the brightest warning signal of all. So what does this mean for you? This is my personal take, my reading of a deeply unstable situation. If you own physical silver, what you hold in your hand is not valued at $91. Its value is being discovered in the frantic markets of the East, already 30 to 40% higher. Selling now to me would be like trading a lifeboat for a number on a screen that everyone else is fleeing. If you own paper silver, an ETF, a futures contract, you must ask yourself a blunt question. Are you owning silver, or are you owning a bank's promise to pay you a cash amount based on a broken index? When the spread is $13, that promise looks frail. And if you're on the sidelines, the calculus has changed. It's no longer about timing a trade. It's about whether you can even obtain the physical thing before the door shuts. Premiums are soaring. Wait times stretch for months. The disconnect between paper and physical isn't an anomaly. It is the new, terrifying normal. The window to easily convert digits in an account into a tangible asset is slamming shut. I have to say, if this perspective is helping you make sense of these turbulent times, I'd be grateful if you'd consider subscribing. Staying informed as this unfolds is critical, and I'm committed to tracking every step. What happens next is, of course, a matter of speculation. But the pattern seems clear to me. We will see more volatility, more desperate attempts to control the paper narrative, but each attempt will only highlight the physical truth more starkly. Then, a trigger. A default on a delivery, a national stockpile announcement, a major corporation unable to source metal. That will be the moment the paper dam bursts. The $91 fiction will collapse toward the $130 reality, not in a gentle trend, but in a violent gap-up repricing that will rewrite portfolios overnight. Targets of $375 an ounce, once seen as distant fantasies, could arrive in a breath if this squeeze accelerates. Let me be clear, this is my assessment of the facts as I see them. The $13 spread is not a minor blip. It is a financial fever chart spiking. It tells us the paper-silver system, is in critical condition. The real economy, the one that builds solar panels and microchips and protects savings, is already paying a different, higher price. The decision before you is profound, yet simple. Are your assets tied to a dying system of paper claims? Or are they anchored in the physical reality that system can no longer control? The East has made its choice. The West is sleeping through the alarm. The spread is $13. It is a measurement of more than price. It is a measurement of credibility. And right now, the meter is running out.